Good afternoon, everyone. I just wanted to say a couple words, and then maybe we'll go into a little bit more interactive, because I always find that a bit more enjoyable to watch. And just really touched upon, how is fixed income looking at ESG, especially in Europe, because there are so many regulations coming out of Europe at the moment that are making asset owners, be it private banks, institutional, retail, have a think about, well, what do we do with this? How do we address this? I'm just briefly going to talk about, well, how are we doing it and what we think the important components are. So I think first off, you need to have ESG embedded in your corporate research. I think that when you're looking at corporate issuers, it's really important to look at what are the ESG factors that actually have a material impact on a company, as many speakers have said before. But I think one area that isn't focused on as much is countries and governments. And I think that that's an area that's going to get more and more focus of, what countries violate UN compacts, so you shouldn't own them, which ones are lower rated, and therefore you should get a better return in order to invest in those. And so I think that most people focus on corporate issuers, but I think you really also do have to look at governments, and that's part of our investment process. In addition, I think you have to kind of start with, what do you want to exclude? Are there any things that you just say, it doesn't matter how good they are, we just don't want that? And I think Europe is quite advanced in this standpoint. They exclude mainly tobacco, nuclear weapons, pornography, other areas like that. And so I think from that perspective, I think it's important to take those out. But we've actually taken a step further as well and said, well, if there's companies that have a certain percentage from thermal coal, which for us in our European accounts is 5% of revenue is from thermal coal, then they're excluded from our universe. And so even though an analyst might say, well, it's a good company, they do a lot of good things, we just say, well, actually for our sustainable funds, that's not really possible. And then lastly, you can do all this bottom up and, what are you doing from all these different areas, but you also have to look at it in portfolio construction as a whole. So, are you willing to buy CCC or really egregious ESG rated companies? And we say no. We say, we don't want to own those, but we're not going just for best in class. We're not going saying, we want to look for the AAA, AA ESG rated companies, because we don't think there's a lot of alpha left in those. I think where you can really add alpha in the fixed income space is in lower rated ESG companies. So people are rated maybe double B, but yet management has identified that they need to help fix some of their ESG criteria, and they're now on that journey to do that. And as they move through that, they will become more and more attractive to other investors. And I think that's a way for investors to gain alpha, because as their ESG methodology gets better, more and more investors become interested in it. In addition, we have to remember there's a lot of issuers in corporate space that may not be equity issuers. So you actually are capturing a different part of the market, especially down in high yield. There's many of these that are private companies, and so they don't actually have an equity base, so you can't engage with them on that front. And lastly is really the engagement. And I think this is a couple of previous speakers spoke about this, but I think engagement is just incredibly important on an issuer level of what are you actually doing to address some of the concerns that we have about different parts of your company, but also looking at it thematically. So, three of the thematics that we look at are, what is the water usage of the company? And we look at, how are they trying to reduce that? Because we know water is a limited resource. Number two is, CO2 emissions. That's no surprise. We run a green bond fund as well. So that's something that we think that is really important to get carbon down. And that all kind of encapsulates into climate change. And so we're looking more and more of how can we make our portfolios less carbon reliant. And I think that's really the direction that we're going. And it's really that direction that I think everybody is going, partially because of regulation out of Europe, but also I think climate change, the regulations that are being put in place globally are meaning that your chances of having stranded assets are becoming larger and larger. So you need to really look at your portfolio and see how do you integrate this on individual basis across the portfolio, but also across these themes longer term. And I think with that, you get better returns, and also you actually be able to get some of the impact that you want to do as an investor.
Great. And so now onto the sort of question part. And of course, everyone can hear that you're an American, not in Paris, but an American in Liverpool or the city of London from your accent. And I'm not saying this as a critique because I'm myself a quarter American. But I think you're from Maine originally, right?
I went to school in Maine and I went to school in Connecticut, but my father's in the military, so I've lived all over the U.S. So,
okay, great. And I think so it gives you a broad perspective. So the fact that, that you're American, but you're based in Britain and you cover Europe, of course, geographically, it gives you that broad perspective. And so the first question I had for you is the following, because I think you personally have pioneered, or you're one of the pioneers of the notion of ESG applied very systematically to the sovereign issuer side of fixed income. So I think you've developed over the years progressively an in-house model, which I think is not, not publicly available, but it's an in-house screening or scoring model for ESG applied to governmental sovereign issuers. Tell us a few words about that and how your modeling has evolved in the past 3-4 years.
Well, I mean, we built the model 2-3 years ago, and it really was to focus on, we knew that we could say that the corporate side was integrating ESG, but in a lot of our European aggregate accounts, there's a large portion that's governments. And we said, well, you can't really say you're doing something if you're just ignoring, half of the portfolio. And so we wanted to basically come up with not necessarily who is the best at it, because within Europe, most countries are actually pretty good at their ESG compared globally, but really try to get a better gradation within that, looking at what are the ESG, E, S, and G risks, and then also how does the country's government moderate some of that? How do they manage those? And really putting those two together, looking to see what is the best ESG score for this country. In addition, it also comes up with what our model believes out of 68 different characteristics, the 3 biggest risks are to the country, which is quite useful because it allows you to focus on those. Those are the biggest risks. And they do change over time, but also, when you talk to their treasury officials, you can, start to question some of these. And it's really interesting how that has evolved. That it used to be you didn't get much of a response, whereas now they definitely are being asked by more and more people. And I think the more people that try to engage with companies and countries, the more you actually get movement and disclosure as well as regulation. And so I think that's incredibly important. But we don't look at it as who is the best. It's more what is the ESG risk and how much yield are we given to compensate for that risk. And so it's kind of but it's a work in progress. And our biggest issue with it at the moment is that it is an annual, because a lot of governmental data is annual. But we're now looking to see, is there a way that we could do this on a more frequent basis, or at least parts of it, maybe quarterly, to try to get the movement of that ESG score a little bit faster. However, we all know governments move really slowly, so I'm not expecting this to be radical change just because we go to maybe a quarterly or semi-annual data, but I do think it would be good to have something that is a little bit more up to date.
Okay, and I see a question from Francois Dumaine regarding the EU taxonomy and more particularly the social or the S side of taxonomy. We'll come to that. I'm just throwing the idea here. We'll come back. I'm telling Francois that we'll come back to that later. But for now, I just want to ask you one more question regarding that in-house ESG screening or modeling or scoring. So I guess many of the metrics that you assess annually, for lack of a more frequent flow, many are kind of CRA, S&P, Moody's, sort of, country risk, country finances, purely quantitative, I guess. But some, correct me if I'm wrong, some must be more qualitative. And I guess you've had to go through the emotion of saying, okay, this, I'm looking at that qualitative idea or notion. I'm going to invent or come up with a scale, A, B, C, D, E, or good, mediocre, bad. How easy or how difficult was it for you to incorporate these qualitative notions into a model?
Yeah, that's a really good question, because actually everything that we have actually is an index that is publicly available outside of a paywall, because we wanted to make sure it was something that other people, when we gave them it, they could go and look at it. It's not like we're trying to create this magic. It's just more that we want to be try to incorporate all these different issues. And so we do get a lot of information from a lot of supranationals. They have different indices on education and poverty, et cetera. And so you can incorporate that into your model to actually use a mathematical way to incorporate what some people may see as more of a qualitative approach. Because if you try to blend it too much, it becomes messy, as you say.
Right. Before we move back to the sort of corporate side of the credit market, and perhaps, answer the question we had on the EU taxonomy and trying to focus on social issues. And I think you're also a board member of a Liverpool-based foundation or endowment, right?
London, but yeah.
And you do social work, and so that maybe nourishes your thinking regarding the S in ESG, but we'll come back to that later. So now I want to wrap up that government pillar or sovereign pillar with one last question. So of course, we also what happened in Brazil 7 or 8 months ago, because typically when there is pressure put on finance ministers or central banks or the Treasury Department, with all due respect to pension funds and asset management companies, the pressure comes mostly from the IMF, the World Bank, the EU Commission, and the big lenders, historically less so from asset managers and pension funds, even though things are changing thanks to people like David. But I mean, we also what happened with Brazil six or 7 months ago, when for the first time, to my knowledge, you had big, Scandinavian, Australian, French pension funds being open and telling very bluntly, the finance minister and the president, look, if you guys keep on, burning pieces of the Amazon forest, you know what? We won't buy any of your new issuances, and we may even dump, the Brazilian bonds. So it came as a shock to the Brazilian government itself, and it took a full week for Brazilian policymakers to adjust their response, which went from, saying, we don't care about pension funds and asset management companies, to 7 months later saying, oh, sorry, don't worry, in the future, blah. So it's interesting to see that when they flex their muscles, large asset management companies and pension funds can have an impact. And so back to Europe, which is your playground, I guess, we see a lot of critique laid at the doorstep of, and I'm not saying it's always legitimate, but, a lot of critique laid at the doorstep of the Polish and Hungarian government, blah, 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 which allegedly aren't as liberal and progressive as the Karl Popperian European ideals, which may be true to a certain extent. But I mean, do you personally believe that in the coming months and quarters, we're going to see more of that, and that, investors, asset managers, and pension funds will also start being more vocal, like they did for Brazil 7 months ago?
Well, I think it's a slightly different issue. I do think that you are seeing more and more asset managers and pension funds become vocal about what they want from countries. At the moment, it seems to be mainly focused on the environmental side, if we're honest with ourselves, all the countries, they have to pass a certain governance level, or otherwise you just don't buy them. But I do think it's the environmental side that people are most focused on at the moment, and the EU is obviously addressing that to a massive degree with its new budget and rescue program to green Europe. And so I think that is really where the focus is. I think later, could we see that? Yes. I think that, you could see investors say, well, we're not sure we want to be associated with these particular governments because they are not, conforming to what we feel is good governance. But that is the reason. It's not necessarily because of just one part, I don't think. I think it has to be a broader remit.
Right. And now back to I'm aware of time, and once again, I want to thank you for having joined us today. It's a pleasure to hear you. And back to the corporate side of the huge, enormous fixed income remit. Now, on the corporate side, if we look at the indices or indexes, the main indexes, let's say 1 year ago, 2 years ago, 3 years ago, 6 months ago, compared to today, something fascinating has happened both on the corporate bond side and on the equity side. it's the share of voice or the share of index of all companies has collapsed dramatically. It's, I mean, you know, it's amazing. I'm 49 years old, and before working for a think tank and pension fund association, I used to work in investment, and I've never seen that in my whole life. That the collapse, the proportion of ExxonMobil in the equity and corporate bond index used to be huge. And I'm talking about Exxon and Mobil separately. And now Exxon and Mobil together have completely collapsed. So the share of voice and share of indices has collapsed. And in Europe, it would be the case for, you know, BP, Shell, Total, etc. And we've seen, you know, renewable energy companies or utilities focusing on clean energy, like Enel's size in the indices has conversely risen substantially in the past 9 or 12 months. So that's telling us a lot about what's happening in the market. So all that is, I'm saying that because on that corporate side of the market, there is more correlation with equities, right? So it's a lot of variation in the corporate bond side are correlated, as we say, with equities. And is it also true in terms of investment advocacy and lobbying? So do you guys work, the bond guys, do they work together hand in hand with the equity guys at the annual general meetings? Or is it still very much everyone his own way in his own silo?
I think it's a combination. I think there are some areas where we can work together. I think there's obviously scope for more interplay there. I think that in general, what a fixed income investor cares about is not always the same as the equity. So we're interested in making sure we get repaid. But I think once we start heading down this the ESG route and sustainability, I think they do become very similar. And I think from that perspective, there can be a lot more synergy there. But at the moment, we're slightly more separated, but I would like to see that become closer together. And we do have that in some industries, just not all industries, because there's some that it just isn't as much overlap.
Right. And of course, because you cover both the sovereign and corporate part of the capital structure, that allows you to see things that perhaps only, you know, those who are purely focused on the one side may not see as clearly or as quickly as you. So one question about quantitative easing and the abnormally long, excessively complacent approach to monetary, policy that we've seen from many central banks in the past 12 years or 11 years. And now it's with the so-called COVID crisis and the post-COVID or post-Brexit or whatever, with all these things happening at the same time, and the stimuli and stimuli, we're seeing a lot of money being printed directly or indirectly. So are you worried about that pile of debt burgeoning the world over, and it's linked to the continued, artificially low, excessively long quantitative easing? So are you worried that, both governments and corporations may have had it too easy and may have been borrowing a bit too much?
Well, I think that you have to look at them kind of independently, because governments should ideally borrow when the economy is not doing as well to be countercyclical. That's what you want your government to do. And then rein in spending when things are good. Europe, I believe, is going to probably take 2 to 3 years, maybe even 4 years to recover from this latest setback due to COVID for growth to get back to where we were at the end of last year. And so in that environment, I think that it's perfectly rational that central banks need to make sure that the financial markets continue to function. And so therefore, since we're already at zero or negative in most countries, we start printing money. I think that's perfectly rational expectation. And I expect that to continue for a while. On the corporate side, I think that a lot of corporates have actually, from what we've seen, taken advantage of this to actually term out their debt, get much lower interest payments they have to make. And so I think longer term, it's not necessarily a bad thing. The real question comes that they have a lot of cash sitting on the balance sheet at the moment because they want to be defensive, they want to be safe. It's, you know, it's very difficult to know what's happening at the moment. Is once we get back to a more normalized world, is what do they do with that cash? Do they spend it on acquisitions, or do they just pay down their debt? If they pay down their debt, then I think everything is fine. And it'll probably be someplace in between. So I think overall, in Europe especially, rates will be low for an extended period of time, and there will be this continued move for yield. But you have to do that in a very methodical way rather than just buying anything at the highest yielding, because as they always say, you know, if it looks too good to be true, there probably is a reason that is that way. So you have to really look at, you know, what is the financial risk for corporate and government, and what is the ESG risk for them, and factor that into your decision when making your investments.
Right, and I'm aware of time, but perhaps, you know, because I'm at the same time receiving questions from Olivier in Brittany, who's filtering the audio and Facebook questions while I monitor some of the Zoom questions. So we're trying to triangulate, as they say in American English. But so I think we still have, you know, 5 or 6 minutes. So a lot of questions are about Brexit, and a lot of questions are about, you know, the future of the EU and UK postpartum. So once again, you know, you don't need to tell us the future, but like, what is your personal hunch, you know, your personal intuition about what may happen to bond markets in Britain and Europe in the first days of January if there is a very hard no deal, abrupt no Brexit deal?
Well, that actually makes the question a lot easier. If there is a no deal Brexit, then we would expect that UK gilts will actually do very well in the first couple of weeks or month of January, as people realize this is going to hit the UK economy, probably, you know, 2 to 3, maybe 4% of GDP. But also it's going to create more friction in trade, which is never very good. And also the pound will probably be under pressure. In Europe, I think the response will probably be a little bit more muted. I think that in general, yields will probably decline a little bit more, but they're already quite low. And that's really because the hit to European GDP is probably about 0.4, 0.5% of GDP per annum. It's not nearly as large, but it's much more focused. So countries like Ireland will be impacted quite significantly. And, you know, how does the EU deal with that? Germany also, exports a lot. It will be hit. Spain will be hit due to travel. So I think that it really is by individual country within Europe, whereas the UK, you definitely would see, you know, rates fall. You probably would see the Bank of England, you know, continue its very dovish tone, and you would see the pound probably come under pressure.
Right, and I see on screen, perhaps for the last question to wrap up David's interview. I see on screen we're joined from the city of New York, from Midtown Manhattan, by Susan Bishoprick. Bonjour, Suzanne. And Suzanne, of course, was for many years the CIO of the UN Joint Staff Pension Fund. She's also a managing director of Global Sovereign Advisors and advisory board member to the Singapore Economic Forum. So perhaps an American view, looking at Europe with American eyes, even though Suzanne is partly Swedish and British herself. But how do you see basically the fixed income, or what is your current perception of government bonds, gilts, EU bonds from New York? And what question would you have for David?
I think the first, by the way, for full disclosure, I'm a subject to the Queen. I'm a UK citizen, born in London. As for bonds in general, I think the term fixed income is false marketing, because in most well-rated bonds, you're getting a negative yield. So I ask you, as pension fund advisors and managers, is it really within our fiduciary duty to fund central banks by paying interest to them?
Yeah, I think that's a great question. I think that if you look at just some government bonds, agreed, they do have negative yields, and I think that you could argue they probably have negative yields for the right reason, because you know that if you give them money, you will get your money back. And real yields, actually, they're actually quite decent because inflation is so low. But I think we need to look at for investors is more the broader canvas of fixed income, because an equity is just a share in a company. It always will be. It always is. Whereas within fixed income, you have governments, and then you have corporate bonds, and then you have high yield bonds, and you have subordinated bank bonds, and there's all plethora of fixed income. So I think there still is definitely fixed income that offers value. I think that and you can see this when we have risk off moments where equity markets fall. Fixed income still does balance out some, not nearly as much as it used to, but I do think it does some. And so I think that most pension funds look at the longer end of the yield curves, and a lot of those are still positive, not very. But the real question is do you want to put it all into more volatile assets, or do you want to keep some in fixed income so to balance the portfolio, so when you do get points of volatility, you can take advantage of them? And I think that's what fixed income still offers, as well as I do think it can offer income, as long as it's a diversified portfolio rather than agreed. If you just go and buy 10-year Germany, that's probably not going to help your pension fund as much.
Thank you, Suzanne. Thank you, David. And I think what's fascinating is the diversity of the asset class, because some people have that conception about fixed income as in one block. But from one geography to the other, and from one sub-asset class to the other, the risk profile and the return profile, in spite of the zero or sub-zero interest rate we see in some jurisdictions, is actually quite wide. I want to thank David Zahn once again for that beautiful presentation.